Hi and welcome to the latest Magellan Quarterly Update for Q4 2021. My name is Matthew Webb and I'm here with Ofer Karliner, one of the infrastructure portfolio managers. Ofer, infrastructure unsurprisingly lagged in the cyclical uptick in markets recently, but in Q4 of 2021 performed really strongly. Can you tell us a little bit about the reasons for that?
Yeah, infrastructure was up. All sectors were up in Q4. One of the key drivers, though, was utilities. Utilities had a particularly good quarter and actually a particularly good December. So utilities have actually been laggards probably for 2020 and 2021, and laggards from a stock price point of view rather than a earnings point of view. Earnings have been extraordinarily robust throughout that period. So to put that in context, in 2020 we had one portfolio stock downgrade earnings during the entire COVID peak of the COVID crisis, and that was National Grid, and they actually said they were going to make that up in future years. In 2021, in our entire universe, one utility downgraded guidance. So they've been very robust from an earnings point of view. They've been very stable, very reliable, very boring, which they should be. And the problem is boring and reliable isn't very sexy when the market's off to the races. The market was very hot over the last couple of years as things rebounded as of the reopening trade, and they've been left behind to a degree. What we saw in December in particular was the market being more concerned about inflation and about economic growth, particularly as a result of the Omicron strain. And we saw rotation back into defensive, and as a result, utilities did particularly well. Their inflation protected and low economic sensitivity for their earnings meant they were a natural place to go to for people who are concerned. The other sector that did well was communications, so tower companies. They did very well as well in Q4. Again, that was something very similar, where they have very reliable earnings streams, and there's a rotation to these defensive earnings. Lastly, it was rail, and rail had an exceptional quarter. Rail, and this was despite the supply chain constraints continuing, despite labour shortages. What we saw with rail was real pricing power coming through. So they were able to put through real price increases, material real price increases, and that saw their stock prices rally quite strongly.
Thanks, Ofer. Touching a bit more on the pandemic, airports are probably the most impacted industry worldwide by the pandemic, but clearly investors remain really confident in this asset class, evidenced by the takeover of Sydney Airport that we're witnessing as we speak. Can you tell us a little bit about what your discussions with airports have been as we've obviously now experienced Omicron, which is yet another thing that's preventing people from travelling?
I think initially the concern was going to be this was the vaccine escape mutation strain that everyone was worried about. That hasn't materialised. So we saw some flights cancelled, passengers changing travel plans initially, but we haven't seen the wide scale cancellations that we saw in previous outbreaks. And to put that in context, ANA reported that their December traffic was down around 30% on 2019 levels. November was down 27%. So there's been an impact, but it hasn't been super material. That's largely due to vaccines reducing the incidence of serious illness. There's been breakthrough infections, but people aren't getting as sick. And obviously the Omicron strain is less severe. So we haven't seen countries locking down. We haven't seen borders being shut in any material sense, and that's really adding to confidence in the medium-term profile of traffic. So absent this escape mutation, where we're back to zero in terms of having to recode vaccines, medium-term outlook's still very good, and we have a very long-term horizon like the people looking to take over Sydney Airport do have. Then certainly there's a lot of value to be had in owning these assets.
Thanks, Ofer. I want to take a bit now to ESG and particularly the environment. A lot of people are talking about carbon emissions and measuring that, looking at stranding risk and looking at transition risk. And look, I know we've spoken a bit about how weak carbon accounting measures are with respect to, in particular, power transmission and distribution companies. Can you share a little bit about what your thinking is there, please?
When we think about ESG risks, and the way we think about them is around risk to cash flows. So looking at demand degradation, regulatory intervention, lower allowed returns, for example. When you look at a pure carbon accounting number, that doesn't really reflect that risk. And I'll give you an example. So transmission distribution, Spark Infrastructure, a pure play transmission distribution company. It has 1,303 tonnes per $1 million of revenue in terms of carbon accounting score. Now that reflects line losses. It has no discretion over how the power is generated. It connects to coal power generation in Victoria, for example. It loses some of that power in transmitting it to the grid, and that gets accounted to them. Now, when you think about the risks that Spark faces, they're very, very low. There's very little asset stranding risk. They have material opportunity to connect up new wind farms, new solar farms, new batteries, etc. Plus they need to harden the grid to deal with people charging their cars at home, for example. So again, material upside, very little asset stranding risk. When you compare that to a company like BP with a carbon score of 179, clearly the risks there are very much to the downside. There's genuine asset stranding risk, and there's much less upside potential from decarbonisation. So, carbon accounting score doesn't really reflect the risk. We do have some companies that have high carbon scores, genuinely high carbon scores from emissions to do with power generation, and those are predominantly US utilities which have regulated generation. Now, to simply exclude them ignores, again, the opportunities that these guys face and the fact the impact these guys are having on carbon reduction. The EPA put out a report last year, in 2020, saying that 80% of carbon reduction between 2005 and 2019 came from utilities. So they are meaningful impact investments. They also have material opportunity from decarbonisation. So they're shutting down old legacy coal and legacy gas plants and replacing it with renewables, wind, solar, etc. Now they get paid to do that. They put capital in the ground, they get a return on that capital. Most of the utilities in the US, the very integrated ones, talk about 5 to 7% EPS growth for the next 5 years. We think they can do that for probably 20 years or so. There's a material opportunity here.
Thanks, Ofer. It's great to hear there's such a fantastic opportunity in moving the world to more decarbonisation whilst highly profitable for these businesses. I want to just finish off with, infrastructure's renowned as steady and stable, inflation linked, and some yield. Can you tell us a little bit about how you're viewing the asset class now, and if investors can continue to rely on those characteristics going forward?
Yeah, look, absolutely we can, with the caveat that you need to define your universe correctly. So most people think about infrastructure as essential services, and that gives demand reliability, but we want cash flow reliability. So to do that, we have to strip out those companies that have excess exposure to competition, commodity price risk, and sovereign risk. And when you do that, what you end up with very stable cash flows, generally inflation protection, yield and capital growth. And inflation protection is really interesting at the moment. People are very focused on inflation, and the vast majority of a properly defined infrastructure universe has either explicit linkages to inflation. So I think for toll road raising prices quarterly or annually based on inflation levels, implicit, so utilities being able to pass through higher costs, or real pricing power. And we saw that with the rails when they were able to pass through their costs quite easily given their dominant position. So again, as long as you define the universe correctly, we can be very confident that the really attractive attributes of infrastructure and the diversification benefits you get from that should persist through time.
Thanks very much for your time today, Ofer.
Thank you.
And thanks everybody for your time. We very much appreciate your interest in our infrastructure capabilities. Please feel free to share this video with anybody you think is interested. All the best, everyone.